We have Evan Katz here. Again, great opportunity. So thank you to him for doing this. Seasoned hedge fund industry leader. He's got experience in capital raising and alternative investments. He's the managing director of Benoni Capital currently, a Manhattan-based hedge fund consulting and advisory firm. They specialize in institutional capital raising. So again, raising money for those big companies and big, funds and investment groups. He has been a featured speaker at top finance and investment conferences and has guest lectured at institutions like Columbia, Harvard, NYU, USC, and Wharton. Great insights into hedge fund strategies, fundraising, industry trends. So we're really excited to learn about that stuff. And with that, Evan, do your thing.
All right, Christian, thanks very much. So again, it's great to be here at University of Denver. Looking forward to sharing some insights regarding hedge funds, careers in hedge funds. I've also taken the dozen or so questions that people have sent in advance, and we'll get to those towards the end. And looking forward to a good evening here and a presentation to you all. And thanks for having me. Uh, so here is my contact information, but you don't need to type it all up. You can just wait for the QR code at the end or take a screenshot. But if there's a QR code at the end, you get all my contact information there. So just a real quick background, native New Yorker, born on Long Island, went to Wharton, was a finance major there, ended up going to law school. So in the air quotes of Zoom, I am a recovering lawyer. Actually was in the same class as Michelle Obama at law school. But I've been in hedge funds for about 20 years or so, spent 5 or 6 years as the director on the Hedge Fund Association Board of Directors, and for 3 years in a row was nominated as one of the best hedge fund fundraisers in the industry. And in 2011, won the Young Leadership Award. So just a bit of brief background. We'll talk a little bit about the state of the hedge fund industry and then everything you want to know about hedge funds, but we're afraid to ask. So right now, the number is not exact, but hedge funds are roughly about a $5 trillion industry. And I said on the side, explain why. And basically, the reason is that for a while, hedge funds were a bit out of favor. For maybe about 10 years or so after the Great Recession, there was a lot of quantitative easing. So the Federal Reserve was printing money. Money was very free and flowing. And as you probably know, when that happens, it tends to boost the stock market. And when it tends to boost the stock market, you end up in a situation where a lot of stocks in the S&P were going up in a straight line. And if you are running a hedge fund where you try to make money when the market goes up or down, but the stock market is going up in a straight line, it's kind of hard to beat the stock market when the Fed is pumping a lot of liquidity in and most stocks are flying. After the Great Recession, and the S&P had almost a 20% correction, people started to remember that they call it hedge funds for a reason. They try to make money in up, down, or sideways markets, or at least not to lose as much when the S&P is down. And as a result, hedge funds were once again the new heroes when a lot of them either made money during the Great Recession or did not lose nearly as much as most long-only funds or indices did. So it's about a $5 trillion industry right now. Other quick points about the hedge fund industry currently. I think the hottest strategy is probably private credit and lending. But like I say on the slide, be careful when anything gets hot or popular. History repeats itself, as the expression goes. And if you remember the tulip craze in the Netherlands hundreds of years ago, the dot-com boom, the subprime mania, every time things get so frothy and things get very trendy, you may want to think twice about those strategies. Like I say on the slide, when everyone gets very excited about a stock or a strategy and piles in, including the person who cuts your hair, it may be a bit overstated, over frothy, and something to be wary about. Another thing about the hedge fund industry, just real briefly, in terms of the state of the industry, smaller managers tend to continue to outperform but get far less money. This has been one of the proverbial banes of the hedge fund industry for decades. Studies have shown that smaller, younger managers tend to outperform. Obviously, there's great big funds and horrible smaller funds, but by and large, the smaller funds tend to outperform. But there's an old expression which goes, nobody ever got fired for buying IBM. Ask your parents. So, smaller funds tend to outperform, but they still have trouble attracting assets. And that is just, that still continues to this day. Recently, there were some regulatory changes that were struck down by the courts that would have caused hedge funds to be a bit more egalitarian and give information on a more equal basis to investors, which recently got struck down by the courts. So basically, where our hedge funds are, there's a lot of great funds, and we'll get into why some of the better ones are more successful and why the lesser ones often aren't. So, real quick, initially, what is a hedge fund? What is a hedge fund? Who started the first hedge fund, and in what year did he do it? When I do these in person at universities or conferences, I will actually ask the question. There's a bit of a hint. It just passed the diamond anniversary. As you may know, the first hedge fund was formed 75 years ago. It seems like less, but 75 years ago. Alfred Winslow Jones, A.W. Jones, what is credited to be the first hedge fund. Trading stocks, long short equity plus leverage, designed to help make money if stocks go up or down or the markets go up or down, and to be less correlated. In essence, trying to make alpha meaning to outperform the market. So 75 years ago. Uh, what is a hedge fund? What types of hedge funds are they? There's probably at least a dozen hedge funds. I'll say maybe a bit about some of the ones on the list. As you probably know, long short equity is still by far the number one most popular fund. You're long Coke, you're short Pepsi because you think Coke is going to go up and Pepsi is going to go down. That is still the number one most popular strategy. There's activist hedge funds where they try to get involved with the company to try to make it perform better, either cooperatively or under threat of taking it over. There is, of course, algorithmic quantitative or systematic hedge funds that try to use computers and a lot of data, and a bunch of other hedge fund types too. Global macro tries to, you might say, pick countries or pick sectors or pick regions instead of picking stocks on a more global, holistic basis. Try to pick who's going to benefit from what's going on in the world, and a bunch of other strategies as well. Uh, as I say in the slide, at this point, hedge funds are pretty much almost anything nowadays. There's a lot going on in artificial intelligence, a huge emergence of using AI and big data in the world of hedge funds. There's everything from auto and car loans can be collateralized and sold as a hedge fund. There's commodities, oil, gas, silver, cryptocurrency. I never thought I'd live to see the day. BlackRock, Fidelity, Goldman Sachs, JP Morgan, and Morgan Stanley are involved in allocating or investing in crypto. Actually, at Benoni, we have an affiliated hedge fund that is one of the top performing funds in the world with an extraordinary 7-year track record. And we are exclusively crypto. It's done almost 100% a year, net of fees over roughly 7 years, completely crypto. There's currency hedge funds, there's patent hedge funds. Pretty much almost anything can be a hedge fund these days. And as I said before, private credit and private lending is probably the hottest thing now, but be careful when things get maybe too hot. Another definition of a hedge fund is pretty much any liquid trading strategy, not private equity, not venture capital, anything traded over a market, currencies, stocks. They typically have a management fee, as you probably know, and typically have a performance fee. Used to be 2% management and 20% performance, although now that hedge funds can be multi-billion dollars, one could argue, do you really need 2% of $10 billion to run your fund and keep the lights on? And typically they have redemptions quarterly, and those are, the vast majority of hedge funds. This is the one token presentation cartoon, entering Greenwich speed limit 2 and 20. I saw this in a big institutional investor's office many years ago, and they were kind enough to let me share it. Greenwich, as you may know, is sort of the informal capital of hedge funds because many of them were in Greenwich and Connecticut for tax reasons. So the one token cartoon for the night. So as I said before, there's a lot of quantitative easing after the financial crisis. A lot of hedge funds could not outperform the S&P in a bull market, and hedge fund fees came down because hedge funds could not outperform a straight up bull market. But then, as I say in the slide, came 2023, and the S&P was down almost 20%. And for people under the age of 40, 50, or 60, this was probably the first time they saw a stock market go down 20% in a year. And even the more sophisticated older people had kind of forgotten that stock markets can go down as well as going up. So hedge fund fees were lessened over the course of time. Part B of the hedge fund cartoon, most of them are now somewhere along the lines of about 1.5% and 15% performance fee, although we'll see where that goes. So we'll talk a little bit about how hedge funds are structured, what type of entities, how and where they're created. Some of this is a little bit dry, but all I can say is when I got into the industry, I wish I knew this. I had no idea about most of this stuff. So hopefully this will help you if you decide to go into a career in hedge funds. So initially, there's the hedge fund itself. I say here, ABC Hedge Fund, typically formed in Delaware, like many corporations are, uh, and ABC Hedge Fund Delaware. And then there's the investment manager of the hedge fund and the general partner. So the investment manager runs the hedge fund, and that's typically a Delaware entity too. So you might have ABC Hedge Fund in Delaware and ABC Investment Manager running the hedge fund. There's also a separate general partner of the hedge fund. Why both is a tax reason, not for this conversation, but as they say, you can Google it. So there's the hedge fund, the investment manager, the general partner, and of course the limited partners. And again, if you want to know why the investment manager and the general partner are separate, you can Google it, legal and tax reasons. They can be onshore or offshore. If they're not Delaware, they're probably going to be offshore, Bermuda, Cayman. Um, and the reason that most funds have an offshore vehicle is for U.S. not-for-profits. Not to get into the weeds, it's also for tax reasons. But virtually all not-for-profit investors, endowments, foundations, pensions invest in a hedge fund's offshore vehicle. And so that is how it's done. So it's an onshore vehicle and an offshore vehicle. And the last thing, as says on the slide, sometimes investors can allocate through what's called a separately managed account, which is basically just a brokerage account that the investor sets up and the manager manages the account. So rather than managing an entire pool of capital where all the investors are in it together, the manager can manage just a separate account for a large institution. So one other thing that one should know if one's going to be in the hedge fund industry is the other cast of characters that are part of this industry, so-called service providers, and what does each of them do to help out with the running of a hedge fund. And when I got into the industry, I was not familiar with the huge support that hedge funds get, whether they're large or small. So specifically, not surprisingly, there of course are the accountants that do the audit and the tax for the hedge funds. They audit them, they do the tax, what accountants basically do. For those who are looking to learn more about the industry, I put some names down here, some of the top accounting firms. A lot of them have hedge fund newsletters, and frequently you can subscribe and get the hedge fund newsletters or read their websites for what's going on in the world of hedge funds. In addition to accountants, there's also so-called administrators, basically an outside organization that helps run the hedge fund, that gives investors comfort that it's not just the manager, that there is oversight, independence from an anti-fraud standpoint. And I've listed some of the major administrators there. One fun fact, and it was not fun, was that when Bernie Madoff's, it wasn't a hedge fund, when Bernie Madoff blew up and everyone discovered it was a huge Ponzi scheme, one of the things about Madoff was he did not use a third-party administrator. When Bernie Madoff said he was up a certain amount per month, he was saying it himself, and his people were printing the statements that said to investors, "We're up this percent," and well, we all know what happened there. He was making it up. So almost all hedge funds these days use a major administrator, which are multi-billion-dollar shops, to report their figures. So our affiliated hedge fund, we don't say that we're up almost 97, 98% a year since inception. We have administrators and we have auditors who say it, not just us. Obviously, hedge funds need bank accounts. They often have compliance consultants who advise completely regarding compliance and regulatory. Now, cybersecurity is a major issue. So yes, everyone has to have a cybersecurity consultant. And they often have insurance policies regarding errors and omissions. And last but not least at all, they have a so-called prime broker who basically it's with whom the hedge fund trades. So the hedge fund trades through a so-called prime broker. They may provide some leverage, and they also may do something called cap intro, where they introduce the hedge fund to more investors. And I listed some of them here: Citi, Goldman Sachs, Morgan Stanley. So whether you're running $1 million, $100 million, or $10 billion, you're still going to have most, if not all, of these so-called service providers. So also important to run down who works at hedge funds and what does each person do. Some of it may be obvious. I'm sure some of it's not. So obviously, the first part, portfolio managers, he, she, or they, who are basically running the portfolio, who are making the investment decisions, supported by a team of analysts, traditional hedge fund model, and that could be whether it's fundamental or whether it's quantitative. If it is a quant shop, there are going to be people who are doing coding and models. So I don't know if you've crossed paths with MATLAB or Python or other interesting computer modeling and Wall Street finance modeling languages. But in addition to the PMs, the portfolio managers, and the analysts, if you're at a quant shop, you're going to have people who do coding and models. And as we'll get to later, even if you're not at a quant shop, there's more and more people who are doing big data work. We'll get to that in a little bit. Uh, CFO, Chief Financial Officer, uh, all the big hedge funds have them internally. If they're a smaller fund, they may have them externally on a sort of a rental basis, so to speak. Also, Chief Operating Officer, accounting and trading, so-called back office, and then also General Counsel, of course, lawyers who help do all the legal work. And I skipped over, but I want to mention the Chief Risk Officer. This is something we'll get to later. Uh, all the big hedge funds should have a chief risk officer, which is the person whose job is to worry about what might go wrong, could go wrong, did go wrong, and try to prevent it from happening. And some of the questions that you sent in address some risks and volatility and other things. So there either should be a chief risk officer at a big fund, or there should be someone who owns that role. Uh, Documents. What documents do hedge funds have? Hedge funds have a lot of documents. All legal entities do, but hedge funds have their share. So hedge funds have marketing documents and legal documents. So uh, the first marketing document, so to speak, is the so-called one pager. It is what it says. It's a one, sometimes two-page summary. It's what I call the baseball card of hedge funds. The name of the fund, the strategy, their track record, maybe a little bit about who runs it. It's the baseball card for hedge funds, everything on one or two pieces of paper. Then there's the hedge fund PowerPoint, which is the longer marketing document, roughly, I would say, typically 15 to 20 to 25 pages, going through the team, the strategy, the track record, the service providers, the risk controls, the terms of the fund, the fees. It's basically a 20 to 25 page PowerPoint usually that covers pretty much everything. Next is the so-called private placement memorandum or PPM. This is what the lawyers draft with the hedge fund managers and the team. This is I would say 50 to 100 page document going through everything under the sun about the fund, the team, the risk factors. And, after the Great Recession in the 20s and the big crash and the advent of regulation, it is disclosure. It is the disclosure document. It is 50 to 100 pages of disclosure about everything you could possibly think of. Next is the limited partnership agreement or the LPA. And this is basically what I call the prenuptial marriage contract between the general partner on behalf of the fund and the limited partners, the endowments, the foundations, the family offices, the individuals. It's basically the prenuptial, it's the marital agreement. It says what the relationship is of the fund and the investors and the responsibilities and the reporting. And again, another probably 30 to 50 pages that hedge fund lawyers draw up for each hedge fund. The next one are the subscription documents. That's basically the documents whereby an investor subscribes and sets forth his, her, or its or their investment amount. Pretty self-explanatory. There's the investment management agreement, which is the agreement between the fund and the investment manager, which basically discusses how the investment manager will manage the fund on what terms and conditions. And last but not least, there's the virtual data room or VDR, which is an online portal like a very fancy Dropbox, which contains all of the above documents plus the audited financials. The hedge funds could contain their Form ADV, their Form PF. Basically, so instead of having to email 20, 30 documents to investors, you can give them a link and they can go online and see all the documents. What types of entities where people are the most common investors in hedge funds. And I put a link to a video I did about specifically about fundraising. So who invests in hedge funds? Uh, they can include individuals. They frequently do. So you have U.S. individuals, and since they are taxable, they would typically be onshore. Delaware, they'd invest in the Delaware entity. You have non-U.S. individuals who would be offshore, say the Cayman entity, to avoid U.S. tax withholding. High net worth families, accredited investors, so-called single family offices like billionaire people whose names you see in the news, and so-called multifamily offices where families pool together to invest collectively. And then there's also investor clubs like Tiger 21, where a lot of millionaire and billionaire families look at investment ideas and invest either collaboratively or separately. So again, not to get too inside baseball, the not-for-profits, the NFPs, the endowments are offshore, foundations are offshore, pensions are offshore, and then the for-profit investors, the individuals, the fund of funds would be onshore. Who regulates hedge funds? When I got started in the industry, that's a great question. I was not sure. The answer is basically it depends on what they trade. So there's not one regulator for hedge funds, so to speak. So for example, most hedge funds trade equities, stocks. Uh, since if you are trading stocks, you are regulated in your hedge fund by the U.S. Securities and Exchange Commission because you are trading securities. If you're trading futures, you're regulated by the Commodity Futures Trading Commission, the CFTC. By the way, in many other countries like the UK, there's one regulator for what I lovingly call all the financial stuff. So in the UK, whether you're trading stocks, bonds, futures, there's one regulator who regulates you. In the US, it's a little bit crazy having multiple regulators. And sometimes there's issues. What if you trade both? But because of historical reasons, it's just the way it is. And it's probably not going to change, at least not in our lifetime. And as I say at the bottom of the slide, what if you're not trading equities and you're not trading futures? What if you and I open up a hedge fund that trades rare baseball cards or fine wine or something like that? There actually is no regulator. It's an interesting situation. So we trade rare baseball cards or fine wine. The SEC does not regulate us because we're not trading securities. The CFTC does not regulate us because we're not trading futures. We have no regulator. So very strange situation. As I say at the end of the slide, the SEC always has anti-fraud jurisdiction, meaning if you commit fraud, whatever you're trading, you're in trouble, as you should be, but there's no regulator on a day-to-day basis. I want to say a couple of things about hedge fund blowups. This is not losing a little money. This is not losing some money. This is what the slide says, what the term means. True blowups. We can each have our own definitions, but it's, hedge fund disasters. I've been in the hedge fund industry for roughly about 20 years or so, and there are thousands of hedge funds. And I am sure that there have been some hedge funds that have had massive losses because they've gotten everything wrong. Let's say they had 26 positions, A through Z, and they were wrong about 20 out of 26 or 24 out of 26 or 18 or 20 out of 26. But in my 20 years in the business, I've not heard of a hedge fund truly losing an insane amount of money because they had 26 diversified positions and they were wrong about most of them. I'm sure it's happened, but no. As they say on the slide, it's rare. It's typically the stupid, dumb mistakes. And I will list them here. And you could be in 10th grade and understand, I think, what these mean. You can certainly be in college and understand what these mean. And yet, seasoned hedge fund managers, twice or three times your age, have made these mistakes or forgotten about them. So, as I say on the slide, if you're not going to get all your calls wrong and lose money on all of them, how do you blow up a hedge fund? Well, you can be too concentrated in a very few positions. Okay. You could also be too concentrated in a few sectors, or you could have too much leverage, meaning you're borrowing money to invest it. So, leverage is basically borrowing money from a bank or a leverage provider or a prime broker, and you can invest more. So, if you unlevered would have been up 20% one year, with leverage, you might be up 40%. The problem, of course, is what if you lose money? If you lose money, instead of being down 10%, you could be down 20. So again, it's a double-edged sword. So again, typical hedge fund blowups, overly concentrated in a position, a sector, too much leverage, or more, or all of the above, or most of the above. So, for example, uh, I don't know if you were following stocks in 2007, but Bear Stearns and Lehman Brothers were two of the largest financial institutions in the history of the world, uh, employing hundreds of thousands of people. And if in 2007 you said to your mom, dad, sister, brother, to your dog, Bear Stearns is going to be out of business in the next 2 years. Lehman Brothers is going to be out of business and bankrupt in a year or two. You would have been committed for being certifiably insane. They would have told you you were insane. That's impossible. And what happened at Bear Stearns and Lehman Brothers wasn't that they got a lot of things really badly wrong. They were heavily, uh, they had heavy exposure, big exposure to subprime mortgages. And we'll get to that maybe a bit later. You may know what happened with that. And they were overexposed and overlevered. And when you're overexposed and overlevered, one little thing can cause a problem because it becomes a big thing. Or I mentioned on the slide, long-term capital when genius fails, or when genius failed, excuse me. If you have not read the book or seen the movie, I think there's a movie, definitely read the book. It's basically when Nobel Prize winners have a phenomenal hedge fund that is extremely sophisticated and understands all the correlations about everything, except they were levered about roughly, I think, 20 to 25 to 1. So what that basically means is they were borrowing $20 for every dollar they invested. And if you're always up a little bit or up a lot or down a teeny bit, then you're doing great and the leverage increases the returns. But if you're levered 20 to 1 or 25 to 1 and you're down 5%, you're out of business. You're gone. You've lost everything. So it's a great book when genius failed. Surprisingly, there was a recent study that I forget the percentage, but a large percentage of recently graduated MBA students did not know what happened to long-term capital. So I recommend reading the book because it's the same stuff. Can't guarantee you're going to make a ton of money in hedge funds, but if you follow four simple rules, you will not lose a lot of money. And then if you know what you're doing, you'll probably at least make some money. So that's my one slide about blowups, but maybe the most important slide on here because it's one blow up is one blow up too many. The other bad news, Debbie Downer slide or hedge fund frauds. Got to put one slide out of 50 about hedge fund frauds. Similar to blowups, I often say that highly sophisticated frauds are rare. It's usually not the Tom Cruise Mission Impossible, stealth, CIA complicated fraud that defrauds people. It's typically relatively easy stuff. As I mentioned on the slide, Madoff was a $65 billion Ponzi scheme where he was administering his own fund and he told you what his returns were. And that's what he said. Pedders was a 3 billion, in air quotes, and only $3 billion Ponzi scheme regarding receivables. And he had fake orders. No one bothered to check with the lawyers or no one bothered to check with the companies that allegedly had the orders. Rothstein was a $1 billion Ponzi scheme. Some of the legal settlements were real and some were fake. Again, no one bothered to check with the law firms whether these legal settlements were legit. And as I say at the bottom of the slide, all easily detectable if investors had just checked with the independent third parties. So enough about blowups and enough about frauds. Many of the questions, not surprisingly, from university students are how do I get a job in hedge funds? And I will try to give you some great points. If any of these work, I won't ask for 10% of your income, but just let me know that it did work. I'd be really happy to hear that. I actually get emails and phone calls from people who've used some of these tips to get jobs in hedge funds, and it is wonderful. Somebody even bought me lunch in New York when they came here. So these things actually do work. Initially, I say it in parentheses, LinkedIn is great for getting a job, and so are recruiters, but typically when you've had some experience. So LinkedIn and recruiters are great, but probably not to get the first job in hedge funds. It's when you're a little bit older and more seasoned. So a couple of points. Alborn Village has hedge fund news and jobs. Great resource. Hedge fund jobs and news, totally free, definitely worth doing. LinkedIn, certainly worth setting up alerts. Occasionally you get something more junior. Definitely worth setting up alerts in LinkedIn. They do have a ton of hedge fund jobs. You never know, you might find something. Recruiters, as I said before, typically for your second, third hedge fund job, probably not for your first, but I gave some names there. The pro tip on the slide, especially for trying to get your first job, and this goes to some of the questions that people asked, is to on LinkedIn look up and do a search for people in hedge funds who are graduates of your school. So if you went to ABC College or XYZ College or University of Denver, do some searches, put together a list, get some email addresses, and most people who went to college ABC or got their MBA at college XYZ will typically help out, at least do what they can. I do it it's just not, it's a natural thing. Everybody wants to. The other bullet point is there are a ton of trade organizations in the hedge fund industry, some local, some regional, some state, some national, some international. And I put down one, two, three, four, five, six, seven of them there. Uh, join them all, get the newsletters, read, show up for the meetings. It's just the nature of any business. Every industry has its trade associations. You'll learn, you'll meet people. Definitely worth doing all of the above. Um, a couple of bullet points, and some of the questions went to, getting a hedge fund job, keeping a hedge fund job, how to be successful in hedge funds. Some of these are 100% obvious. There's probably one or two, though, that people tell me, thank you, they were not obvious. Okay, the first one is the obvious one. Do great work, obviously. It goes without saying, if you don't do great work, well, what's the point of having the job? And if there were layoffs, or even if there aren't, you'll be the first one let go, that type of thing. The second bullet point is a little bit more subtle. Try to brainstorm, find, and do things that you were not assigned. So, first thing is do the job you've got and do a great job at the job you have. But once you've been at a firm for a while, maybe you can think of something that no one's thought of already, whatever that could be, data, research, looking into something that no one's doing that they haven't asked you to do. So if you can figure out something that might be helpful, volunteer if you've got the time, and take that on as well. The third bullet point is kind of applies to every job, whether you're a hedge fund or a law firm or an accountant, whatever you're doing. Basically, if you can be a revenue generator, try to be a revenue generator. Meaning, if you can help bring in business, bring in clients, definitely a good idea to do so. Whatever you can do to bring in business, or if you are helping to produce great numbers and great returns, that's also revenue generating as well. So whatever you can do to bring in money to the firm, increase returns, bring in clients, it's probably the best job security you can ever have, no matter what you're doing. The fourth bullet point is always do the most annoying part of the job. Every job, every relationship, marriage, jobs, everything has the fun parts and the less fun parts. But whatever the so-called annoying parts are, the expense reports, the timesheets, whatever it is, you got to do that well and on time as well. I cannot tell you how many friends and I talk about our companies, and without mentioning names, the people who work for them and running a business and direct reports. And as I say here on the slide, you don't want to be the person that your boss is complaining about over his or her dinner table conversation with their husband or wife. You don't want to be that person. So, do a great job, take on some more stuff, try to bring in money or improve returns, and don't be a PIA. You probably know what that means, and your boss's dinner table conversation. Uh, some people had asked about life lessons, and some of these may be the most important thing I could ever tell people. Some have a few things to do with hedge funds. Some have nothing to do with hedge funds. We'll get to some of these later in the Q&A. One of the real minutia in the weeds ones are when you go to networking events, take notes on business cards. I have probably received praise for two things more than anything else I've done in my life. One is the Benoni Capital virtual Zoom background. People love it. They love the color and the design. And the other thing is taking notes on business cards, because it's very simple. If you go to a networking event and you meet 100 people, and you might have something in common, or you can do business with 25, or you might get a job with 10 of them. Unless you're one of those people who can memorize the phone book, and I cannot memorize the phone book, you're never going to remember the next day who was the one that did this strategy, who's the one who might want to interview me, who's the one who might have an investor for my hedge fund. take notes on business cards, just a couple of comments, a couple of stars. I've got my own little code just so I can understand what I mean. And the next day, it's like, okay, yeah, these are the ones I know what I've got to do. Uh, Great practice point. Second bullet point, I cannot be everyone's, but maybe try to get a mentor, someone in the industry who can give you 15 minutes a month. As I said, if you go on LinkedIn and do a search for, people who work in hedge funds who, went to your high school or went to your college, most people, if you if you ask them to be a mentor, they may say yes or no. If you ask them to be a mentor and give you 15 minutes a month, okay, everyone's got 15 minutes a month. They'll probably do that. Bullet point number three is uh, not really the hedge fund bullet point. It says diversify stock in your company. If you ever are at a startup or form a company and your company does incredibly well and you make a fortune, that's wonderful. Do not keep going along business as usual with 99% of your assets in one company stock. I've lived through the dot-com boom and bubble and a bunch of other ones, and I have seen people whose company did amazingly well and no fault of their own. After the stock went from 0 to 100, it went back from 100 to zero, or it went from 0 to 100 to 100 to 30. So the way I phrase it is this way: you would never take all of your money and put 99% of your money in one stock. You're not that stupid. I'm not that stupid. No one's that stupid. You would never just go into your bank and put all your money in one company stock, hopefully. But if you found a company and you start a company and your company does well, you may have 99% of your money in your own company stock. And even though you didn't do it the first way, you're in the same position. So, I've seen people make that mistake. This could be the $1 million mistake that you don't make because of tonight's presentation. Uh, and the fourth bullet point on the slide is enjoy Denver, enjoy New York City, wherever you end up. But don't get too caught up in the scene, which is easy to do after college. Uh, Life can quickly pass you by. So have a lot of fun, run around, have fun in New York or Denver, wherever. But, don't do it for too long. Life moves pretty quickly. I'm going to get to the Q&A in a second, but this is the slide where I promised all the contact information would be on the QR code. And of course, my picture's in the middle of it, as one does. So the slides will be sent around by Christian. But if anybody wants, you can take a screenshot or just simply point your camera at the QR code, but the slides will be sent around as well. So I did want to get into the Q&A because most importantly, perhaps, or equally importantly, I wanted to hear the questions that you all had. I want to try to answer all of them. I think it's about 13, about a baker's dozen. Question one, what do you think separates a successful hedge fund from an average one? I mean, this could be a 3-hour conversation, but I would say this. Obviously, let's start with the assumption that the successful hedge fund and the average one have some ability to pick stocks, shall we say, long, short, whatever their strategy is, some ability. Obviously, some are going to be better stock pickers than others. That's incredibly obvious. I didn't even put that on the slide. Some people can hit a golf ball better than I can. Actually, everybody can hit a golf ball better than I can. But I put down three things that are a little bit more subtle, I think. A is what I called ego and emotion, both buying and selling. And that's where, they say on Wall Street, never fall in love with the trade. Whether you're buying or holding on, never fall in love with a trade. It's similar to never keeping 99% of your money in your company's stock just because you're the founder. Uh, Probably virtually every mistake, and we're going to get to some more life mistakes, are ego, emotion. It's just dumb mistakes that if you saw it on an exam and it was somebody else's life and you saw it on an exam, you would never pick the option. So don't fall in love with the stock, whether it's buying or selling. Uh, if you have to cut your losses, cut your losses, live to fight another day. And that gets into B, poor risk controls. Risk is probably one of the most important things at a hedge fund. And you don't hear a lot of talk about it, except at conventions regarding risk. So the things I mentioned before, overconcentration in a company, overconcentration in a sector, too much leverage, long-term capital management. How could that happen? If a hedge fund has a chief risk officer, a CRO, who's in charge of this, how could any of those things I just mentioned ever happen? And they do. So not to get too inside baseball, but there's a great story people tell about how when the institutional investors come in to meet with the team, and they meet with the whole team, and they meet with the team separately to make sure they get the same story, not verbatim, but roughly the same story, and to get to know people on a one-on-one basis. Frequently, they'll ask the chief risk officer, tell me about the last time you stopped a trade before it went on, or you made somebody adjust a position. I mean, these things should be in stone somewhere. So basically, ego and emotion, poor risk controls. And then I think successful hedge funds from average ones. The other one is just lack of operating capital and a commitment to institutionalize and properly fundraise. I know dozens of small funds that are crushing it. Uh, Not every year. The only person up every month is Bernie Madoff, as the expression goes. But I know a lot of small funds that have a great batting average, a great slugging average, and they never become big hedge funds, which means their investors are making a fortune and the people who are killing themselves are not. So, that is the third thing I would say is that if you want to raise serious institutional money, you've got to be institutional ready. You can't do this on the cheap. So, for example, I once said at a conference that there's something great about hedge funds and something bad about hedge funds. The great thing about hedge funds is that you and I can start a hedge fund with $100,000, a Bloomberg terminal, in our pajamas in a garage. That's the great thing about hedge funds. We can start one with 100,000 bucks and turn the key and we're off to the races. The bad thing about hedge funds is that we can start it with $100,000 in our pajamas in a garage, meaning hedge funds, they're very easy to get to first base. It's very simple. You know, if you want to start your own restaurant, if you and I are going to open up the world's greatest Italian or French restaurant, it's a little complicated. You need permits, you need to hire people, you need a storefront, you need electricity and gas. And I'm not a restaurateur, but all this stuff. It's more complicated, but hedge funds are easy to get to first base, but then what? So you need operating capital and you need to make it into a serious business with serious professionals, serious service providers. And if you don't know how to do it, because maybe you don't, hire someone who does. And if you can't afford to hire someone who does know how to do it, then one of the best secrets, I'm not sure if it's in this presentation, is go to the people who know you the best and say, I want to raise some money to make you a partner in my hedge fund. And say to them, I'm raising a couple of $1 million and you're going to own a piece of the hedge funds, and you can go out and hire people who know what they're doing to build the institutional quality hedge fund. And it's typically, the four F's: friends, family, former colleagues, former investors. But if you're just getting out of college, it's going to be friends and family. Or if you're young, friends and family and a couple of colleagues. But, basically make sure you have the operating capital to make your company a success, because there's two things you need to be successful running a hedge fund. One, great returns, obviously, or good returns. If you're losing money every month, it's not going to do very well. But the second thing is you need assets. And if you're making great returns with very little money, it's nice your investors are making a fortune, but you're barely scraping by. So that's question number one. Question number two, how do you see the hedge fund industry evolving over the next decade? Uh, Great question. Without any doubt, artificial intelligence. Uh, I was a computer geek and a computer wonk many years ago doing stuff in AI when no one had any idea what AI stood for. AI stood for Allen Iverson, the basketball player. No one knew what AI stood for. AI is definitely most of where I see the industry going at this point. It is not a panacea. And just to be perfectly clear, not every artificial intelligence hedge fund is going to do well. Hopefully that's obvious, but many of them hopefully will. And what's going on in AI is that computers are finding relationships and places where profitable trades can be made that a lot of humans just never could find on their own. Now, obviously, you don't want to let the machine just run amok and put on huge positions because they think the computer thinks it's found something. So, in our affiliated hedge fund, the cryptocurrency hedge fund with a phenomenal track record, we use a lot of data and we use a lot of people. And it's sort of a team process where we do a lot of stuff that is fundamental and we do a lot of stuff that is quantitative, but we do not simply, put 100% of the money on one trade because the computer said so. Still, we've got to be diversified. There's still human oversight. There's still diversification. but AI is definitely where things are going, among other places. Question three, what are the most important skills for students aspiring to work in hedge funds? I say in air quotes the usual, no surprises here, I don't think. Uh, Study, hard work, dedication, learn the industry, going above and beyond, uh, doing great networking to get the interviews. I mean, uh, pretty much it's a lot of, as they say, blocking and tackling. So, it's doing all the basics, showing up on time. It's as I've often said, put yourself in the shoes of your boss, uh, and pretend you're the boss and do what you would want if you were the boss, what you would want your direct reports to do. Be on time, do great work, go above and beyond the call of duty. And just to be clear too, I don't mean people have to work 24/7. I spent my entire professional life in New York City, and there's this whole culture of, working 24/7 and 100-hour weeks. And personally, I think that's ridiculous. Yes, if you're a litigator on trial, you work 18-hour days. If you're in the middle of closing an M&A deal, you can work an 18-hour day. If you're an accountant during tax season, you're working long days. But on a personal note, to be working 18-hour days your whole life for the whole year round, it's ridiculous. I just mean do a good job, work hard, respond promptly. That's basic. It's like any other job. We'll get into a few questions, maybe a few things that are more hedge fund specific. How do hedge funds differentiate themselves in a highly competitive market? Question four. Uh, Good question. There are now, no one knows exactly, roughly 10, 15,000 hedge funds, depends on your definition, but there are a lot of hedge funds. And it is an increasingly competitive market. And some of the questions address it later, but let me actually maybe get into that. So it used to be back in the day, a very different world. Uh, Information was harder to come by. So if you were big hedge funds with a big team, you could weed out information and find it, and work and get it wherever the information was. Nowadays with the internet and everything being online, it's made it easier for small hedge funds and other hedge funds to get information almost as good as some of the bigger funds. There's obviously some differences. So it has made it a more competitive environment. It's sort of like going back, uh, stock prices. Ask your parents, ask your grandparents. Stock prices used to be in decimals, in sixteenths and 30 seconds of a dollar. So Coke or Pepsi and Apple and IBM, wouldn't trade at $100 or $100.01 or 2 cents. So the margins, the spreads were much bigger, and brokers and investors and hedge funds and Wall Street people in general often could make a lot more money simply because the spreads were bigger, because things were not decimalized, as they called it. It's the same thing now. There's much more competition. Uh, Anybody with a computer and a bank account can try to be a hedge fund manager, and not all are going to be the next, Michael Steinhardt or Jim Simons or Millennium or Izzy or Stevie or Point 72, but anybody can try. So it is a very competitive environment. So the first thing is how to differentiate yourself. Obviously, you've got to put up great numbers. I mean, it's like I said, it's like your baseball card. Are you batting 200, 300, or 400? Are you scoring 5 points in every basketball game, or 20 or 15 or 40? That's the most important part. I mean, everything else doesn't make a difference. I mean, obviously you could have the greatest institutional quality hedge fund in the world. If you're down 3% a month, it doesn't matter. But the other thing I mentioned here is invest in marketing and institutionalization. Because going back to one of the prior slides, I mean, I am a hedge fund marketer. I'm a hedge fund fundraiser. I also know a lot about operations, compliance, and legal. But the days of build it and they will come are gone. They were probably here about 20 years ago. When I first got started 20 years ago in hedge funds, if you were up 25% a year like clockwork, or 30 or 15 or 40, they kind of found you and you were successful. Those days are gone for a variety of reasons, more competition, institutionalization. You could be the best hedge fund manager on planet Earth. If you do not get money to become institutional quality and to get a top marketer, and I can recommend people other than me. There's a lot of people who are great fundraisers. You'll be the greatest hedge fund that no one's ever heard of. It's sort of the opposite of the sports metaphor. You know, if you're in high school and you're batting 400 on the baseball team or scoring 30 points a game on the basketball team or rushing for 200 yards on the football team, you get the idea. The colleges will find out about you. Unless, if you're anywhere in the US or Europe, the colleges will find you. And if you're at, University of Denver and you're scoring 25 points in the basketball game every game or 40 points, the pros will find out about you. And eventually you'll get to the minor leagues, the major leagues, you will have a contract. I cannot emphasize enough how that is not the case in hedge funds. You could be the quarterback of the football team and the equivalent of the Heisman Trophy winner. The hedge fund graveyard is full of great funds that made a lot of money for their investors, but the managers couldn't afford to buy a new car because they didn't have enough assets. So invest in marketing, invest in making your firm institutional quality. Um, Question 5, what strategies are currently most popular amongst institutional investors? I said in a prior slide, I hate the fads and the trends. What's the most popular? I mentioned before that, the tulip bulb uh, bubble, the dot-com bubble, the subprime bubble, SPACs, you know. So I hate the trends and the fads, but for what it's worth, private credit now is extremely popular. Basically, what's happened is that there's been an increased amount of regulation of traditional banks and financial institutions. So since they have more regulation, they can't do as much as they used to. And so hedge funds have stepped in to do so-called private credit, where they're basically a private lender. That's become big. And also cryptocurrency, but let me put it this way, slowly. Um, our cryptocurrency hedge fund was started roughly about 6 or 7 years ago. And it was one of the few back then. And most people didn't know what cryptocurrency was 7, 8 years ago. Then 3, 4 years ago, most people heard of it and kind of knew what it was, but were not investing. And now it's just off the charts. There's that list of funds I mentioned before in firms, Goldman Sachs, Morgan Stanley, major banks, all the big hedge funds are doing cryptocurrency. But let me be clear about one thing. As I say to investors constantly about our hedge fund, we do not just buy Bitcoin and pray that it goes up. That is not investing. That is speculating. We are a combination of long and short cryptocurrency, and we're part fundamental and technical. So when I say we do cryptocurrency, we're just not buying Bitcoin and Ethereum and praying that they continue to go up because I think that's a fool's errand. We're actually doing sophisticated long short analysis, fundamental and technical and quantitative analysis of Bitcoin and Ethereum and other tokens, because we cannot guarantee what's going to happen in the future. There's a famous what's that famous quote by Yogi Berra? I'm not good at making predictions, especially about the future. So, we're trying to make money whether crypto goes up, down, or sideways, but it is definitely fair to say that given the new administration and the decreased regulation and the greater acceptance of cryptocurrency, to quote the famous Wayne Gretzky, it's not where the puck is, it's where the puck is going to. It clearly, all indications are crypto is going to continue to be the best performing asset class. Nation states are considering buying crypto in reserve. Some US states are, but again, that does not mean you should take your life savings and buy Bitcoin. Far from it. Some of your savings, a good Bitcoin fund, that's long and short, perhaps. But anyway, the long story short is we're now seeing a lot of private credit and increasingly a lot of crypto, which is why we're in the space. Question 6, how can college students start building relationships in the hedge fund industry? Well, the first thing is you're here. So congratulations. You've passed the first test. You showed up. So that's number one. But I listed 4 things on the slide, A through D. A, join the national and regional hedge fund professional associations. The list, all the acronyms, the alphabet soup is a few slides back. Join them all and show up at the meetings. B, attend the conferences. You can meet a lot of people by Zoom, but if you want to get to know people in an industry, you got to show up. And like most industries, if not all, they've got their trade associations and they've got their trade association conferences and webinars and seminars and cocktail parties. And if there's ever an industry that has a lot of professional events, including cocktail parties, it's the hedge fund industry. So join the industry associations, read what they write. Sign up, as I said before, for the hedge fund law firm and accounting firm newsletters, read what they write, but then also show up. You've got to get out there. There's that expression that, millennials and Gen Z, whatever we're up to, don't know how to pick up a telephone and don't know how to do anything in person anymore. Yeah, you got to get out there. Point C, I mentioned before, just worth repeating briefly. Use LinkedIn to cold email hedge fund professionals who went to your university or college. Most people will respond. And D, ask someone to be your mentor for 15 minutes a month. Most people are honored. If you went to the same college or high school, hey, 15 minutes a month, maybe it's every other month, whatever it is, most people will do it. That's the way of starting to build relationships. Uh, Question 7, what are the biggest challenges hedge funds face today? Uh, Great question. For many, mediocre returns. And that I won't repeat the conversation from before, but a lot of that is just there's a lot of competition out there. There's a lot of competition. Information has become freer. It's not always free, but freer. The so-called democratization of hedge funds and information and investing. So it's tough. I mean, if you think you can predict what Apple stock will be trading at a year from now better than Goldman Sachs, Morgan Stanley, Millennium, and Point 72, you might be able to, but most people can't. And that's one of the reasons I always say why we're doing cryptocurrency. My partners in our cryptocurrency fund are brilliant. They're phenomenal investors and phenomenal traders. And I say that if they were doing our strategy in, say, large cap equities, we'd probably be making 10, 20% a year, which is great, with a Sharp of 1.5 and a Sortino, if you know what those are, of maybe 2.5. But the reason that we're making close to 100% a year with a Sharp of over 2 and a Sortino of 4 is we're in the crypto industry, which is very fragmented, very inefficient, honestly less sophisticated, less mature, and has a lot of people playing in there who probably shouldn't be. I mean, nobody would do their own brain surgery because they think they're a brain surgeon, but everybody thinks they're the world's greatest cryptocurrency investor. So, that's why we're in the cryptocurrency space, because we're bringing sort of world-class techniques to a very immature, nascent industry. But for many, yeah, it's tough trying to be the best stock pickers in large cap equity. Question 8, what role does technology and AI play in hedge fund strategies? Great question, whoever sent that one in. Great question. A continuing and ever increasing role. And I say in the slide, it's not just for quant funds. I mean, it used to be that data and hedge funds were for quant funds, almost like, separation of church and state, or oil and vinegar, or East Germany and West Germany. There were the fundamental guys and gals who rolled up their sleeves and did research. And then there were the quant guys and gals who did data. That's distinction is blurring a bit. I mean, I don't think you can be a legitimate hedge fund manager, even if you are an air quotes fundamental hedge fund manager, bottoms up researcher, brick and mortar, pounding the pavement, old school, without looking at an ever increasing amount of data. I don't think you can. I mean, data is everywhere. There's big data, there's alternative data. You can Google big data and alternative data. And same thing with AI. So those distinctions are beginning to blur, but everyone is looking for better data, more recent data, artificial intelligence. It's an ever increasing thing. But again, the same caveat, just don't take all your money and give it to some manager because he or she is an AI fund. I'm phrasing it that way, but at this point, you should know better than that. Question 9, how do hedge fund managers, or how do hedge funds manage risk in highly volatile markets? So, as I underlined here, the first thing is I beg to differ with the question, because as I said in the answer on the slide, it's not how do you manage risk in highly volatile markets. You've got to manage risk in all markets because things can change very quickly. So if you're a hedge fund manager in, let's say, 2008 with poor risk controls, and then the great recession comes, or if you're a hedge fund manager minding his or her own business in 2020 and let's say February, and you don't have great risk controls in place, and then COVID hits, how, You better have homeowners insurance before the fire starts. You know, you better know how to get out of the apartment before the fire hits. That type of thing. Same idea. So you don't just need great risk controls and when the markets are going crazy and volatility is up and things are all over the place. You need to have that in place way before day one. So as I said before, funds should have a chief risk officer, a so-called CRO, or someone who, quote, owns risk. And that person should be real. I mean, there have been many situations and descriptions of hedge funds who had a chief risk officer in name only. There was someone who had the title, there was someone who owned the function, but when the PM or the PMs wanted to put on too many concentrated positions or too much leverage, or A and B or B and C or A, B and C, the chief risk officer did not have the authority or the what's the word, political clout or whatever it takes to say no. And institutional investors will, as I mentioned before, will often ask the chief risk officer or the chief financial officer, tell me about the last couple of times where you said no to a trade or you blocked a trade or anything like that. Because if you don't have those things in place and then COVID hits or the Great Recession hits or God forbid a war breaks out or something like that, it's too late to start scrambling to get things put in place, to get them put in place then. It's like another analogy is, and I'll answer the slides for next time, is the notion of a succession plan. What happens, hedge funds are often, as we all know, led by one big figure, man or woman, who founded the firm and has his or her name on the door, either literally or figuratively. And of course, the question comes up, what if he or she gets hit by the proverbial bus? What is the succession plan? What happens if the person gets hit by a bus? What happens if they're in the hospital? You don't want to wait till the person gets hit by the bus or is in the hospital to start trying to figure out what happens next. Same thing here. You want to manage risk when you don't see any risk. You want to manage risk when the markets aren't going crazy. I think I said the point a couple of ways. You get the idea, but it's critical. Question 10, what advice do you have for someone looking to start a hedge fund? Uh, well, like I say in the slide, do so only if two things exist. Number one, you've got a track record. In other words, I may think that I'm the funniest man in America and I should be on stand-up television. Uh, Maybe I am, maybe I'm not, but you got to prove yourself. You may think you're the greatest investment manager of all time or one of, but the numbers don't lie. I mean, and you may be, but you know, you've got to have probably at least a year or two track record before you're going to start raising serious capital. I mean, if it's 6 months, friends and family, maybe, but it's a year or two, over at least over a market cycle, 1, 2, 3, 4 years, something like that. Because let's put it this way, would you give your money to somebody who has no track record or whose track record is 6 months? Probably not. So number one, you need a track record. And then number two, I mentioned this before, I won't repeat it, but you need some kind of operating capital because you need to build a business. So, you need some friends or family backers, people who know you well. And then, if you've got a track record of whatever years and you've got some family backing, that's probably the person who should be starting a hedge fund. And there's other alternatives to starting a hedge fund too. You can join a pre-existing hedge fund. I mean, it's a lot easier if you've got a great track record to show up at someone else's firm, negotiate a deal where you get X dollars a month and Y% of the profits. It's a lot easier to do that than it is to form a hedge fund and hire people and have leases and offices and payroll and everything else. And the two are not mutually exclusive. I mean, certainly, the first step might be working at someone else's hedge fund, build a track record, become successful, but people do, as the expression goes, want to hang their own shingle. But so if you've proven that you can run money and make profits, that's when that's when you start your own hedge fund. And feel free to let me know if and when that happens, and I hope it does. Question 11. What factors do institutional investors consider before allocating capital to a hedge fund? Great question. Maybe 5 answers, probably 10, but I put 5 down here. First one's obvious, track record. Obviously the most important factor. If you're losing money every month, everything else doesn't make a difference. But it's not the only thing. As I said before, I think it's a fair analogy. The track record is the pretty picture on the dating website. It's what gets people's attention. Okay, great, but that's probably for most people not, you know, it may be the first thing that gets your attention, but you're not going to marry someone just because of a pretty picture on a dating website. And the same thing goes here. But track record is number one. The second one is team experience, expertise, and I put in quotes pedigree. I always feel funny when people use the word pedigree. It sounds like a dog, the pedigree of a dog, but that's what they call it. The team's experience, expertise, and pedigree. Where did they come from? Did the PM, did he or she come from well-known hedge fund firms, or institutions, Morgan Stanley, Goldman Sachs, Point 72, Bridgewater, Brevin Howard. It makes a difference. C is infrastructure. Is the firm institutional? It used to be 20 years ago when I first started, if it was two guys, a gal, a dog, and a Bloomberg in the garage, sure, no problem. Those days are mostly gone. You may not need 1,000 people in your back office and 200 people in accounting, but you need some degree of institutionalization where you're doing a lot of stuff in-house. Maybe you outsource. But, as I said before, if you want to know how to do your job, put yourself in the shoes of your boss. What would you want? Same thing here. What should your firm look like? Pretend you're the CIO of XYZ endowment, foundation, pension. There's an endowment office at University of Denver, and pretend you're working there. In fact, some of you might end up working there at some point. What are you going to look for? You're going to look for a great team, a great track record, infrastructure, top service providers. It's got to tick all those boxes. The fourth factor is AUM. This has always been, the bane of a lot of people's lives in the asset management industry. Even though smaller funds have been proven by and large to tend to outperform big ones, again, with exceptions in both directions, there are some horrible small funds and some phenomenal big funds. Even though smaller funds tend to outperform, a lot of institutions will not allocate to small funds. They have all these rules. The fund has to be this size. We can't be more than X% of the fund. And sometimes I'll ask them why. Well, we have a policy. And if I know them well enough, I can tease them a little bit like, well, why do you have the policy? There's not a lot of great reasons. If you've got a great team and an institutional firm, what difference does it make how big the fund is if it's trading liquid instruments, liquid large cap stuff? In other words, what could go wrong because the fund is small that couldn't go wrong if the fund were big? It's a long conversation for another day, but I made the point. And then E is a big one. And this is one of those things that when I got into hedge funds 20 years ago, I had no idea about these people. And I mentioned them before in the constellation of service providers, because institutional investors, in addition to looking at track record and experience and pedigree and infrastructure, also many of them use so-called consultants. And you can Google some of them. NEPC, formerly New England Pension Consultants, NEPC, Alborn, Axia, AKSIA, Axia. There's a lot of these consultants, Wilshire, who advise institutions like endowments, foundations, and pensions, either regarding all of their investments or sometimes regarding the more esoteric ones, such as hedge funds. And these so-called consultants are critical. Most institutions cannot allocate without the blessing of the consultant, or even if they can, are not going to do it. So it's really critical to get on the consultant's approved list. And a lot of the consultants will not approve or even look at funds that are less than a certain dollar amount. So it is a real chicken and egg. How do you get to be a multi-billion-dollar hedge fund if nobody will invest in small funds? It's similar like in private equity and venture capital. How do you get to private equity firm Roman numeral 4, 5, 6, and 7 if no one ever invests in a first-time fund? Same question. Question 12. How important is quantitative analysis compared to fundamental analysis in hedge fund strategies? I mentioned this before. I won't repeat everything. Definitely some convergence. The separation of the two has blurred a lot. Everyone's pretty much using, to some degree, fundamental and quantitative analysis. Unless you're a die-hard fundamental firm or a die-hard quant shop, there's a lot. Most are somewhere in between at this point. Question 13, what's your take on the future of alternative investments like private equity and venture capital? There's great opportunities everywhere. There is what's that Baskin-Robbins expression? 31 flavors in the ice cream store. There are plenty of great hedge funds, plenty of great venture funds, plenty of great private equity funds, and of course, some bad ones too. So that said, and for reasons I've explained on the slide, there potentially may be, and a lot of investors think there are somewhat better opportunities by and large in private equity and venture than there are in hedge funds. And it goes to what I said before. The hedge fund industry has become increasingly competitive, and it can be very hard to do better than the rest when everyone's got largely similar information, and anybody can buy a computer that is a million times more powerful than the computer that went to Mars in 1960, whatever. Whereas private equity and venture capital are more deal by deal related, and they're investing in actual companies, which are more esoteric, more unique opportunities than everyone trying to figure out what the S&P is going to be trading at a year from now. So there may be, by and large, better opportunities in both, but like everything, forget the rules, forget the labels. It's not like all is good and all is bad, but there's great opportunities all around. Which is why if you go to institutional investors like universities, foundations, pensions, and maybe I was going to say too, Christian, it would be wonderful if you could speak to your endowment office, if whether they would speak hedge fund, to the hedge fund students and to the undergrads at the university regarding how the endowment itself picks hedge funds, either alone or with consultants. It might be a great webinar, but there's great opportunities everywhere. Question 14. If you were in college today, how would you prepare for a career in hedge funds? Uh, we covered a little bit of this. Great question. Obviously, take as many finance and accounting classes as you can take, although I think one should get a well-rounded undergraduate education too. So, but take finance and accounting, obviously. Also, this one's less obvious. Probably read the best books you can find regarding investing in general and hedge funds in particular. You can honestly, as I do these days, because it's 2025, ask ChatGPT to recommend the best reviewed, most highly respected books for hedge fund investing, and it'll give you a great list. So take finance and accounting classes, read the best books regarding investing in and hedge funds. Sign up for and join the hedge fund associations. Sign up for the newsletters for the big hedge fund accounting and law firms. Try to be an intern at a great firm, as close to hedge funds as you can get. And then I say, lastly, try to get a job at a big Wall Street firm in the analyst program. Obviously, that's a bit, captain obvious. And equally too, if you're applying for jobs at some of the big bulge bracket firms, yes, use LinkedIn and, find out, out of the 100,000 or 150,000 people who work at the biggest firms on Wall Street, which one of them went to your college or university? And certainly they'll typically be willing to help out and make a few introductions, especially if you've got a good grade point average, if you've taken some good classes, if you've interned somewhere. I think back when I was a lawyer, long story short, we had an intern who came over to us and was working at a law firm, and we were totally upfront with him. We do not hire people straight out of law school. We just don't. We were very honest and candid with him up front. And some of you may know where this story goes. He interned with us. He was phenomenal. He did a great job. He interned for 1 or 2 years before he graduated law school. And the story is going. He became the first person we ever hired straight out of law school. So yeah, take the finance and accounting classes, read some great books, read the articles, read the hedge fund news, intern at a great firm. And, if you're applying to the big bulge bracket firms, which I do recommend, do everything right and then contact the people who went to your college. Question 15, how would a current college student go about creating a profitable strategy? Interesting question. I kind of paused on that. First, do all of the above. So, do your homework, get the experience. And then I think just brainstorm and experiment and see what you do best. I wish I had a better answer, but I think that's really it. In other words, first, do all your homework on the industry and investing in general. Intern and spend a couple years at a hedge fund and see what's going on and really, really learn the ins and the outs as much as you can at your job. And then brainstorm and something will hopefully call out to you that, you're going to be, I don't know, you could be the guy who loves the healthcare sector and you just love healthcare and you become this great healthcare hedge fund. Or you can be the woman who is just really good at alternative data and quant, and you form some great models that tend to make money 7 out of 10 trades and therefore, 8 out of 10 months and so forth. And hopefully something will call to you. But if you do your basic training, do your homework, both literally and figuratively, intern and get some experience, uh, hopefully something will call out to you. This is for me, because it eventually it typically does, for everyone. Uh, Nearing the end of the questions, if anyone wants to have a couple afterwards, if we've got a few minutes, that's great. I'll leave that up to Christian. Question 16, what are the fundamental hard skills that you would recommend mastering to be successful in trading slash investing? Great question. Probably the obvious ones, finance, math, accounting. That one may be a bit more subtle, but if you're going to be a stock picker, you've got to understand accounting and how companies report their earnings and things like that. So finance, math, accounting, data and technology. And nowadays, maybe MATLAB and Python and other computer languages that a lot of hedge funds use. Question 17, if you could do it all over again, where would you start? Well, I am, as they say in the air quotes of Zoom, a recovering lawyer. So I've said this publicly before. I loved law school. I loved the practice of law. But if I had to do it all over again, I would have skipped law school and gone to the analyst program at a major Wall Street firm. So no regrets, no tears shed. Loved the law, uh, enjoyed it greatly, but I would have gone straight to a Wall Street firm if I could do it all over again. And I think it's the last question, next to last. Question 18, what is your personal motto when it comes to life or trading and investing? Um, this is a tough one too. So I tried to put down a couple of things. Some of these things are probably pretty useful. And send me an email 5 or 10 years from now. I think a couple of them will be. Uh, Show up always and on time. We discussed that. Go above and beyond, volunteer. We've covered that too. Uh, C is an interesting one, though. This was not obvious when I was growing up. Learn the toughest thing and be really good at it. And I say in the slide, whether that's brain surgery or the US tax code, probably the latter. My wife and I have a 3-year-old daughter, and making money is not the only thing, and career is not the only thing. But if you want to be at a well-paying job and you can be the man or woman who knows the toughest thing that no one else can figure out, like brain surgery or the US tax code, there's a reason why at a lot of the major law firms, some of the most expensive lawyers are the tax people. So, learn the toughest thing that no one else can do, because then if you're that person, you'll probably be very valuable and get well paid. Um, D, build and keep relationships throughout your career. I've been doing this for 20 years, and maybe, I don't expect anyone to come near these numbers, but right now, my database and newsletter has more than over 100,000 professional contacts and subscribers. Roughly about 50,000 of them are hedge fund investors, give or take about 50,000, maybe a bit more. Endowments, foundations, pensions, fund of funds, uh, OCIOs, and consultants. And roughly about 50,000 are hedge fund senior professionals, hedge fund law firms, accounting firms. I mean, you don't need to come anywhere near that. If you've got a good network of, 100, 200 people who you know well, that should definitely serve you well. And question 19, over the course of your career, what are the most important things you've learned? This is probably the money slide, the biggest one of them all. Uh, and it's in quotes, says escalator. What that means, and I say it on the slide, but I'll say a bit more, is anything that you're going to accomplish takes a lot of hard work and effort. Investing, skiing, learning how to play tennis, learning how to play the violin, marriage. Yeah, I think Malcolm Gladwell, from The Tipping Point, said, maybe euphemistically, that it's 10,000 hours to be good at something. Whether he's being literal or not, the point is it takes a lot of steady escalator-like work to get good at something, to build a hedge fund, to learn how to play golf, whatever. B, though, is the opposite of that. It's elevator. Uh, Doing well, you have to go up the escalator one step at a time, slow and steady for years and thousands of hours. But to mess up is the elevator shaft. That's B. And this is probably the most important takeaway you could ever get. It's really hard to do anything well. It's really easy to screw up and destroy a life or a business by making one stupid mistake. You know, I put on here a bunch of examples. I'll say a couple of them out loud. Drunk driving. You know, you can destroy your own life and other people's lives by driving drunk. Now, thank God we've now got Uber. When I was growing up, we didn't have Uber. Most people know go out drinking. We've got Uber. We're not drunk driving. But, one stupid decision can destroy your career, your life, and potentially put you in jail. Okay, enough of the Debbie Downers. Let's move on a little bit more. But similar concept, bad or no fund risk controls. You can spend 5 years building the world's greatest hedge fund and making a fortune, a small fortune, a big fortune, but you forgot about Evan's slide from 5 years ago, and you didn't have good risk controls. And then something happened, COVID, a war, God forbid, a pandemic, uh, subprime blows up, and you have one horrific month or year that is more than your investors signed up for. And that one mistake may not cost you your life and you're not going to go to jail over it, but it may set you back 5 or 10 years in your career if your fund blows up because of that. Same thing, as I said on the slide, with not diversifying. These are simple things. And the last thing on the slide are Kobe and JFK Jr. Uh, what's that got to do with hedge funds and careers? Uh, Kobe and JFK Jr. both passed way too soon because Kobe was in a helicopter that crashed and JFK was flying a plane that crashed. But it wasn't just that Kobe was in a helicopter that crashed or that JFK was flying a plane that crashed. The weather was bad, really bad. And at some point, Kobe made a decision to fly in a helicopter when the rain and the storms or whatever it was that day were really bad. And at some point, JFK made a decision because he probably had to get someplace to fly an airplane in bad weather. And they didn't die because the plane broke or got hit by lightning. It was a decision that they made. It was a stupid bad decision. So basically, I've given a lot of examples here about it takes hard work to get anything right, but you can easily screw up something, by making one bad decision that's emotional. You fell in love with a company, a trade. You're a founder. You don't want to sell your stock in your company. If you're a founder, you got 99% of your money in one stock, sell half of it. You'll sell half of it. You'll either thank me 5 years later because the company had trouble, or you'll hate me 5 years later because the company did great. But either way, you've taken some chips off the table. And C, when you're making some of these difficult business decisions and life decisions and finance decisions and romantic decisions or whatever it is, don't be so stubborn that you don't ever seek the candid, honest advice from your parents, close friends, or business colleagues, because there have been bad decisions I've made in my life. Everybody has. Someone has either made bad decisions or they're lying. No one's never not made a bad decision. But there's been a couple of times where people did say, "You sure you want to do that?" And I was emotional, fell in love with a position or a stock or a company. So, you know, if your friends, colleagues think you're making a dumb decision, have a long, hard think because you probably are. Anyway, I'll leave it. I'll leave it at that. But those can be big ones. With that, it was actually 19 questions. Christian, if we've got 5 minutes, I'm happy to take a question or two more if we've got it. If not, that's okay too.
For sure. Anyone with questions can just raise their hands, but I actually did have one question. So you talked a lot about how smaller funds often outperform bigger funds. However, those bigger funds are the ones attracting capital. Why would you say that, it's easier for a smaller fund to outperform a bigger fund? Is it just easier to make a higher return with, less giant amounts of capital that you have to invest, or are there other reasons?
No, that's a great question, and actually, maybe I'll add a bullet or point or two next time. It's a great question. So, the question I'll put it this way. Okay, first of all, to be clear, it's just not me saying it. Studies have shown that it's about 300 basis points a year. There are basically two bell curves that overlap each other, and that more assets tend to hurt performance, not help it. And again, exceptions, as I mentioned before, in every direction. There are great big funds and horrible small funds. But your question is, why is there this disparity? And the studies have either proven or hypothesized two things. Number one, younger managers, smaller funds tend to be hungrier.
Yeah.
They're hungrier. The younger, smaller managers are not on their fifth house and their seventh husband or wife, and they're not flying around the world on their private jet. and they're not on CNBC constantly talking about the markets. They're in the trenches because they haven't made their first million, their first billion, whatever it is, and they've got payroll to meet. So they're a little bit more focused on the fund, on the investors, on the positions. And again, there's exceptions in every direction, but that's one of the factors. In fact, there's an old saying in the institutional investor community, and it's part accurate, part exaggeration, but it makes the point. The time to fire your hedge fund manager is when they're going through their third spouse or something like that, or the fourth jet or the fifth country home. And believe it or not, there's actually some investors who, in their due diligence and in their side letters, actually have a requirement that the manager must disclose to his or her investors if they file or get served with divorce papers. I mean, that may be overkill, or maybe it's totally appropriate. I'm not saying they're going to pull out necessarily from investing in the fund,
Right.
but the long and short of it, as we say in the hedge fund business, are smaller managers tend to outperform. They're more focused, they're more hungry, they're just paying closer attention. And also, and you mentioned this in your question a bit, uh, you can be a little bit more nimble running $1 billion than $10 billion. Well, it depends what you're trading. I mean, theoretically, if you're trading large cap liquid equities and you're running 1 billion versus 5 billion, and you have a reasonable number of positions, there should be no reason why you can't trade 5 billion as easily as one.
Mhm.
But when you start getting into 10, 20 billion dollars and some of these huge multi-strategy shops with 40 or 50 billion dollars, there's an old expression, it's easier to turn a speedboat than it is to turn, the Titanic or something. But it's mostly just, they're hungrier, paying more attention, and a little bit more nimble. But for full disclosure and for full fairness, there do tend to be more blowups among smaller funds because they botch the risk, but the returns tend to be better.
Yeah. All right. That makes a lot of sense. I think we are out of time now. If anybody else has any questions, Evan put his contact information on this presentation. I'll share the presentation with you guys. I'll cut up this video. I'll send it out to our members as well. But huge thank you to Evan, and don't over risk.
No,
Thank you, Evan, so
in your
much,
personal
Evan.
life, don't over risk. In your professional life, don't over risk. And that's basically it. No, I want just also to thank you, Christian, for helping to put this together.
Yeah, no problem.
Thanks to the University of Denver, thanks to the event attendees. And as I mentioned in one of the slides, I'm pulling 80-hour weeks. So if I ever do not respond to an email, uh, please do not take it personally, and please follow up like a week or two later. Not everybody sees every email. I get hundreds a day and thousands a week, and uh, don't assume the worst. I try to get back to everybody. So as I said in one of the slides, wait till next week to email me, and if you don't hear anything back, just please follow up in a week or two, and I try to get back to pretty much just about everybody. And thanks to you, Christian. Thanks to the University of Denver and the attendees, and look forward to seeing the video.
Yeah, thanks so much. All right.
Thank you, Evan.